This is Chapter 2 of Prop Trader, and in this segment I'm going to explain a little bit of how stocks trade and also different order types. So starting off here, stocks trade in an auction style type format, meaning that the current price is determined by the high bidder and the low seller. So in the photo below here you can see Nokia has market data that is filled with orders and sells. The bid size is buyers and the ask size is sellers. At 554 you have a bid of 1860, and at 555 you have a sell of 218 shares. The three important columns in this photo is the bid size, the price, and the ask size. You can see the last highlighted in blue, that's 555, that's current price. So if I were to ask you, how many shares could a buyer buy at 555? And the answer would be 218. And actually these numbers are listed as 1/100th, so this is actually 21,800. How many shares could a seller sell at 554? So at 554 you see 1860, which is actually 18,600. Now on to order types. There are two primary order types, market order and limit order. Market order immediately fills to the closest orders. So what that means is if someone were to enter a buy order for 3,000 shares of Nokia on market, it would fill at 218 shares at 555, 1903 shares at 556, 879 shares at 557. And for simplicity, we're not including the 1 for 100 conversion. We're just looking at the numbers as they are in the photo. Next example is, what would a sell order for 3,000 shares of Nokia on market fill at? 1860 shares would fill at 554, and 1140 shares would fill at 553. You can see in the photo you have 1860 at 554, and you have 1835 at 553, and the order was for 3,000 shares, so out of that 1835, 1140 shares will fill. Now limit order. Limit orders are different from market orders. Limit orders will only fill if the limit price is met. So an example here, how many shares would fill with buy order with 3,000 shares of Nokia with a limit of 556? 218 shares would fill at 555, 1903 shares would fill at 556, and 879 shares would not be filled, and they would only fill if someone entered in an order at 556 to sell, or if you moved your order up to 557 with the remaining 879 shares, and then they would eat into a chunk of this 1635 here at 557 on the market data. The next example, how many shares would fill with a sell order with 3,000 shares of Nokia with a limit of 554? Answer is 1860 shares would fill at 554, and 1140 shares would not be filled. And as you can see, if you to place the limit of 554, there's 1860 shares at 554, and 1140 is what's left over. You would not fill any more than this 1860. Someone would have to raise their bid, or you would have to lower your sell down to 553, and then the remaining 1140 shares would fill, as there's 1835 at 553. Now, not all stocks sell like Nokia or have the liquidity that Nokia does here. And maybe Nokia doesn't even always have this liquidity, but on this given day, it was trading heavily. As you can see, there's an order every penny increment in this little range right here. There's only one spot where there's not any sell orders on this side, and the bids are packed down to 542. It looks like there's an empty spot. Now, standard registry SR is the market data right here. And there's not near the orders to sell or to buy. It's thinly traded, and there's a large spread. The spread is the difference between a buy and a sell order. And as you can see here, the buy order is at 652 and the sell order is at 665. That's a large spread. That's a large percentage. So if you're trading, it's going to be more difficult to trade, and you're going to have to limit your position size by liquidity. Position size is always limited by liquidity, and this is also going to lead to more volatility. You can't set as tight of a stop with a trade with this kind of spread. Now what you can take away from this is, in general, always use limit orders. Standard registry, SR, a market order could equal a very bad entry price or a very bad closing price. The spread is so far apart. You're entering a market order with 1,000 shares. You could fill all the way down past 651 here through 647 and lower yet. There's not even enough orders in what's pictured here. Or if you were to place a buy order and the current price was 652, it would fill all the way up at 665. You'd be paying 10 cents higher, 10, 11, 12 cents higher than the 13 cents higher actually than the last price. And with Nokia, it's liquid enough, and there's enough orders here that if you were to enter in a market order for a smaller amount of shares, 100 to 200 shares, it probably wouldn't be a big deal. It wouldn't make much of a difference. But we still prefer to use limit orders, and I'm going to explain a little more about them next. So if a stock price is volatile, let's say Nokia was being very volatile, you could still use a limit order instead of a market order. And to quickly fill an order using a limit order, you're going to place the order a few cents above or below depending upon whether you're buying or selling. So for example, if Nokia the price was going up quickly and you wanted to buy, you thought it was going to keep going higher, instead of using a market order to buy, you could use a limit order. And what you could do here is you could put your limit order and place it up at 558 or 559. And if it had skipped up to 557 quick, or 558, you would still fill. But if it were to skip up even faster, all the way up to 565, and you had in a market order, you wouldn't it wouldn't place the order all the way at 565 for you, because that's probably not an entry you want. Now on the other side, if Nokia price were falling quickly and you wanted to sell, instead of using a market order, you could use a limit order and put the limit order down at 552 or 551 or 550, and then if Nokia fell 3 cents very quickly, your order would still fill. Once in a position, a way to limit risk is to put in a stop limit order that the program will do for you, opposed to you sitting there and watching and doing it manually. So stop limit order is a market order with a limit. So what happens is there is a stop limit order entered, and it will trigger a stock to buy or sell in a specific range. So what this means is, in the ticket here, as you can see, there is a stop price and a limit price. What this means is, if you were to have bought Nokia, and so you buy 218 shares of Nokia at 555 and 82 shares at 556 in this market depth, you could put in this stop limit order and put in a stop price of 547 and a limit of 550. And if the price of Nokia were to fall quickly or to fall down to 550, or excuse me, if the price were to fall down to 547, the stop limit would be triggered, meaning your shares would be sold between 547 and 550, and if the stock were to fall too quick for your order to fill, it would not fill lower than 547. Basically, it is a way to say, if the stock falls to this or goes this high very quickly, fill my order in this range, and it helps limit your risk.